What is going on, guys? This is obviously Jordan here, sitting down for the first video of 2021. Thankfully, I made it this far. We made it through 2020. Of course, if you guys are watching this, I imagine we all made it through the nightmare that was 2020. Literally, all the videos I put out up until this one were recorded like early or mid-December. This is the first time in like a month. Yeah, well, literally a month. I was gonna say a year, but I'm too old for those dad jokes nowadays. But it's been a good month since I actually sat down in front of the camera. So it's refreshing now to to be here to start the year with something that I've actually put a lot of work into. I think I mentioned this before as well in another video, probably my first, if not the second Tesla video, that I was going to talk a bit more about ethical investing and like what ESG means. But when I sat down to do it, literally August, September, I was like, I really don't know enough about this to be putting out a video about it. So let me actually go back to the drawing board, actually research and read more about it, so I can give you guys more of a comprehensive and well understood interpretation of what ESG means and ethical investing means. And then of course we'll sit down and talk about it, which is what we are here to do right now today on January 1st, New Year's Day. Happy New Year to everyone watching this. If it does come out on New Year's Day, it probably won't. But yeah, hope you all enjoyed the festivities. And with all that out the way, let's get into the thick, juicy part of this video. So as I said a minute ago, this is something I've been sleeping on for such a long period of time. And that's mostly because not only did I not know about it, but the main thing is that there's not a very consistent consensus out there anyway about what ethical investing really is. On the specific point of ethics, that comes from the fact that, which I didn't realize before, well, I should have known it before, but I didn't really click in my head, that what's ethical to me may not be what's ethical to someone else. For example, a lot of people that don't want to invest in arms or alcohol, animal testing policies, stuff like that. So there's no obvious ethical fund, because everyone has a different interpretation of what ethics means. So that's where ESG comes in. And just to kind of spoil the majority of this video, a lot of what I'm going to talk about is going to be about ESG, which is environmental and social governance. We're going to go into a lot of depth about that. What E means, what S means, what G means, what that means for investors. And yeah, hopefully by the end of this video you have a much more comprehensible understanding of what ESG means, and how that can affect your current investments, future investments, and to be honest, the future of what, at least in my opinion, the future of the stock market. Before I go into it in proper depth, obviously this is not financial advice. I'm not a financial advisor. I'm still just a second year student living in generic student halls. I don't know what I'm talking about. Yes, I've done a lot of research. Yes, I do invest quite heavily in this myself, but I'm not telling you this for you to go and make your own investments based on what I said. Obviously, it should always go without saying, anything you hear online, do your own research first, speak to your financial advisor first if you have one, and then make your own decisions later on. Never, never, never take anything you hear on the internet from face value. Always do your own work first. So that's just a disclaimer. This is not financial advice. It's purely for entertainment purposes. And yeah, let's get into it. So environmental, social and governance investing, also known as ESG, isn't actually very new. It's actually been around for a very, very long time, but it hasn't really come into the limelight until this year in 2020, and obviously looking forward now to 2021. And actually, before I even go into that in depth, I want to show you guys how much effort and research I put into this. There are so many lines of I don't even script my videos usually. I kind of just sit down and talk off the top of my head. But I sat down today and I was like, what, let me actually script this and figure out what I'm going to say and say it right. So I put a lot of work into this. If you do find this video useful, I strongly appreciate it if you smash the like button down below, comment any questions you have, hit subscribe, do all of that thing there. I'm trying to get my numbers up in 2021, you know what I mean? So yeah, that's enough of self-promo. But as I said, ESG's been around for a while, and it's really coming to the limelight this year. And it's interesting because many parts of it, historically, ESG is always, people kind of looked at it more as environmentalism. Are you focusing on climate change? Do you care more about how your company impacts the environment around you? But this year, and as I said, 2021 moving forward, we're seeing a lot more of a focus on the S and the G as well, and ESG as a whole is becoming a very, very big thing. So that's why we're kind of putting this video out. ESG investing has always been a niche part of the of investing culture, and I've always kind of seen it, especially with my research recently. I've seen it as a lot more of a the misunderstood kind of part of stock market culture, where people, obviously, as I say, it's you're kind of matching your money to your morals. You're kind of putting your investing based on what you ethically believe is right, or you morally believe is right. But that's always been misunderstood as, as I said, environmentalism, or it's you're sacrificing your returns, or you're not going to make as much money this way. But there's a lot of research, and we're going to go into it in depth. There's a lot of research that suggests the opposite. I think it's a very good thing, and I think we're going to go into it in a lot of depth throughout this. So starting off with, what is ESG? Let's talk about what the E means. So E, as I've said several times by now, is our measure of the environmental factors that affect this company. Does it affect the environment around it? Does it contribute towards climate change? Anything to do with like environmentalism, as you can imagine, is what we consider here. And not just in terms of like the products they sell, also the supply chains, how they treat, the actual office spaces and factories and manufacturing and every single part of the company. How does that globally, on a big scale, looking at the big picture, contribute towards climate change, and how sustainable are they? If they're selling cars, are their cars very efficient? If they're selling mobile phones, are their batteries farmed in environmentally sustainable ways, or they're using like lithium from very bad areas, something like that? How does it all contribute in the bigger picture? And this is where you kind of see the buzzwords like carbon neutral, carbon zero, net zero score, neutrality, all these different numbers that kind of are designed to confuse us, but fundamentally all they mean is like they're eco-friendly to some degree. The two big ones, as I said, are carbon neutral and carbon zero. Carbon neutral talks mainly to they input, they output as much as they input, or they input as much as they output in terms of CO2. Carbon zero means they literally don't emit any carbon dioxide, which isn't actually very common. I haven't actually found many companies in my research that are, actually carbon zero, because it's very difficult to run anything in the modern era without emitting carbon dioxide. But carbon neutral is something that a lot of these companies, a lot of these plans are talking more about, carbon neutrality. And that's an interesting phrase. So it's important to understand the difference between those two. So you know that just because the company is carbon neutral, it doesn't mean that they're super efficient. It doesn't mean that they don't emit any carbon. Actually, they probably do emit quite a lot of carbon, and some of these actually really do. But they input, as much as they output, or they save in terms of like efficiency as much as they output in terms of production and manufacturing. So it's important to understand what that means, and it's important to realize that carbon neutrality doesn't necessarily mean that a company is going to have a very high E score of ESG, because as I just said, it doesn't necessarily mean they're super efficient. It just means that the input and outputs are equal. Irrespective of whether you have an optimistic or like a cynical view here, whether you perceive these investors and companies to be like climate change activists, which they're probably not, or if you think they're just like purely concerned about their portfolios, which are probably not either. I imagine they're kind of in the middle. It doesn't actually matter what their motives are. It just, in this case, because seeing people invest more money into more environmentally sustainable companies means that either one, we're gonna champion the better companies anyway that are gonna receive more and more money from this, which benefits the entire the world in many ways. Or two, you're gonna see these companies that if you are sacrificing returns, the companies that aren't getting their money are gonna be like, hold on, we want a piece of that pie. So now they're gonna improve their own standards until the average sustainability level of all the companies in the world kind of improve. That way, as I said, like on the one hand, maybe you're just like championing the better companies anyway, or on the other hand, you're improving the net score of the lower companies, making them more feasible for the future anyway. So irrespective of whatever side you fall on, if you're cynical or if you're like people loving, there's not really anything bad you can take away from having more people invest more money into highly scoring environmental companies with sustainable models. Historically, investors have always had this approach where it's like you almost it's almost, investing is almost like a means to an end. You don't want to invest in something just for the sake of it being a good company. You want to invest in it so that it produces profit, so you get your your sweet bottom line dividend income and things like that. But what this shows is that, and especially when you look at how the governments in the world are improving, making a higher tax breaks and fees and stuff and regulatory fines, it just makes it so much more understandable, so much more like you're a lot more incentivized now to invest in companies that don't that aren't going to get these mad fines, that are maybe going to be in line to get specific tax breaks or government grants and things that benefit the companies that are the more, not necessarily ESG focused, but specifically when it comes to the E, more environmentally friendly, more green. You see this a lot with like EVs. A lot of government have like tax incentives, or like a free £3,000 like UK government bonus if you buy an electric car. Like a lot of money is being put into the greener space anyway. So as an investor, from a completely capitalistic point of view, you can see a lot of potential gains here, because that's where the money's been put into. There aren't many modern day subsidies for tobacco companies, for example, because all of that government pressure is going straight into sustainability, environmentally friendlyism. I'm just making up words at this point. But from a capitalistic point of view, it's also very, very good to invest and to think more about your environmental standards anyway. Like, you know, if you're a company that's not scoring very high here and you end up with these massive regulatory fines or these tax, you know, you don't get as many tax breaks, that's gonna fundamentally affect your bottom line. And like, as an investor, you don't want that. You want to protect your bottom line. So you're gonna want to think more about environmentally stable companies. So the S kind of refers to more, you know, society or the social aspects of your company and how it's run. You know, think about social representation, you know, BME, black ethnic minority employees, underrepresented groups like women, disabled, and not just your employees as well, also your consumers, your board members, your supply chain, and just everything that your company does that involves people, I guess, in a larger sense. You know, and arguably what's more important than that, you know, a lot of these analysts nowadays are also observing how these companies treat their consumers, as I said, like consumer protection. They're looking way down, not just supply chain in this country or like in the, you know, in the delivering products and stuff like that, but also the supply chain right down to the bottom. Are you, you know, sending your clothes to be manufactured by like child slaves in Bolivia or something? Like, how tight is your entire business model in terms of how, you know, your social aspects? And analysts they want to see specifically like how well are you treating people, not just, as I said, not just your employees or customers, board members, but just people in general that are all involved in your company, all the stakeholders. You know, we look at companies like Amazon, we hear all these stories in the press about how people have to do like 20 boxes a minute or something, and they can't even get pee breaks, or they get fired if they miss a target. Like, that doesn't reflect well on a company, irrespective of how green Amazon might be or how well governed they might be. You see some of these, the way they're treating people, and I don't know, I've never watched Amazon, I'm just reading off headlines, but there are a lot of companies that aren't doing so much, you know, aren't doing as well here as they could be. And that's why I think S and G are very important this year, more than ever, as I mentioned earlier in the video. You know, when I talk about shareholders and I talk about supply chain, it's like, big tech is very big for this. I know I just talked about Amazon as well, but big tech's notorious for like a lot of their hardware parts come from, you know, the mind not in the greatest of ways. A lot of the companies do actually sadly involve like underpaid workers, or like you look at tech and you think, you know, big tech, they have this unlimited holiday policy, you can kind of do what you want, they pay you quite well, you have good collaborative working culture. But as I said, you look down the supply chain, a lot of these companies aren't doing as much as they could be. They're working with like, some of them working with child slaves, or they have underpaid workers in poorer developing countries. So there's a lot that goes into, you know, S, you know, the social part of ESG. And as I said, this year I think is a massive thing for that. In the UK, like, I've got some notes here. I'm not going to read out all the companies, but me being a UK investor, I live and was born and raised in the UK. This year, of course, during the COVID-19 global pandemic, a lot of companies, when we went into lockdown, a lot of companies just outright refused to pay their employees. Now, I know that a lot of companies in a lot of other parts in the world kind of did the same thing, but it's still crazy to think, like, Weatherspoon is the most notorious one that I've got here on my list. They just said, nah, like, we're not paying you. You can lock down in your rooms, in your houses, whatever, we're not paying you. And up until the UK government introduced a furlough scheme, which kind of paid back their employees, well, all employees in the country, 80% of their salaries, that was reimbursed by the government. It's like, a lot of these companies are, you know, we've got to be scrutinizing companies like Weatherspoons these days, because it's like they obviously don't give a F about none of their employees, because that reflects, as I said, very heavily on the S score when it comes to ESG ratings. You also see these companies like Boohoo and ASOS I've got down here as well. We often overlook these like fast fashion chains because it's like, it's just clothes, right? You don't really think about it twice, it's you're ordering clothes. But you see a lot of articles online, again, similar to Amazon, similar to Weatherspoons, about how they mistreat their employees, how there's a lot of like racist culture there. It was quite big during the BLM, you know, Black Lives Matter protests. You're looking at how these companies treat people, how they reacted to the news, whether they were like very quick to condemn the actions that went on in America, or if they were kind of like on the sidelines and a lot of these publicity stunts. So it's very interesting. It's very interesting to me. I, for one, am not investing in a lot of these companies that I can tell just don't really care about black people. I'm not going to like name and shame now in this video because I don't have all the names down in front of me, but I always do my fundamental analysis before I invest, and I'm like, these guys, they don't care about me. I'm not going to put money towards people that are actively fighting against people like me. So that's something that is big for me. I'm not going to go off on a tangent about, you know, my own individual ethics and morals, but it's definitely something that's worth thinking about if you do care, you know, more about what your money contributes towards. Now, the G in ESG represents governance, which is actually the hardest thing I found to like really wrap my head around. It's not very well explained on the internet, but you know, bear with me and we're going to try and go through this together. So governance kind of talks more about how the company adheres to like industry regulations. You know, what is their management like? What are their for like something that's very, very prominent actually that just came to my mind just now is like, I'm obviously a big Tesla fan, I'm a big Elon fan, and there's a lot of news, a lot of press came out throughout the course of last year where, you know, Papa Elon was taking like this massive incentive package of like billions of dollars for hitting these certain milestones, and people looked at that like, that's crazy how they're getting so much money just for doing things, you know, and that's a very big hit on the G part of, you know, ESG, the governance part, because it's like, are you focused more on short-term rewards? Are you just doing things like these, making these kind of low-value acquisitions, making these short-term priorities just to make, you know, to reap that money back and make bonuses and make short-term profits? Or are you more concerned about long-term growth? Are you, you know, kind of ignoring these kind of low-value acquisitions? You're kind of ignoring maybe this one collaboration that can make you some money right now because you're focused so much on the long-term and how you can continue growing and improving over time. That's kind of the best interpretation I can come up with what governance means. As I said, it's very difficult to break it down. But if you guys do want, you know, to read more, you know, if you want further reading, you want to try and understand it more yourself, I'm going to put all the links in the description below of all the articles I found online to try and like come up with this video. As I said, I put a lot of work and effort into this. So again, smash the like button and let's continue breaking down what ESG means, baby. So as I said, the most obvious kind of governance area, at least from what I could read up online, is to do with like pay packages, bonuses, and short-term versus long-term. And what that fundamentally means is like, is everyone being paid fairly? Is there like a nice round level from the bottom? But also, as I said, bonuses, like, is it the corporate, you know, the board members taking these massive bonuses while everyone else is kind of getting less? Or is it like everyone's getting a reasonable, you know, compensation based on the amount of work they're doing? Is it more performance based? I know Uber ranks quite low on this because they're like, oh, we don't have employees, we have freelancers that, you know, they're not eligible for pensions or healthcare or whatever, because they're just freelance, they work when they want to work. And obviously people are like, nah, we're actually, you know, we're employees, this is our sole job, we want those worker benefits, we want that pension plan, etc., etc. And a lot of these, this is another thing that's obviously quite big in tech. You're trying to find out what the right balance is, what people are actually doing, and are the board members, you know, are the employees being managed properly, not just for long term, for short term, but also, as I said, for pay. Is everyone being paid right? Is everyone actually on a level playing field when it comes to the company's long-term repeatability and long-term sustainability? Or is it just, you know, as I said, short-term, let's just pay employees less so we can make more money in the short term? So it's quite a lot goes into it. As I said earlier as well, the links are in the description below if you want to do more further reading, but that's kind of my brief overview of what the E, the S, and the G mean in terms of ESG. So now that you have an understanding of what ESG means, I think I want to briefly interject by saying that the difficulty here is that so many companies have different ways of valuing what ESG means. Every investment firm, you know, all these different funds have their own different metrics. They use different data points. They kind of weight different things more heavily and lightly depending on what they do and how they affect the company. So while, as I said, ESG has been around for a while, and while it's still massively expanding and improving, it's still, you know, it's still a work in progress. In terms of specialisms in that industry, there's still a lot in that sector, I should say, there's still a lot of space for more specialisms, for more better understanding instead of generic data points. So me, myself, a lot of my friends, I spoke to one of my friends recently as well, we're looking at doing like an ESG qualification so we just get more rounded about it and also make it more of a mainstay in the industry. But it's definitely something that needs a bit more work. It's definitely something that's a bit, you know, very understood. And despite my brief kind of overview as to what it is, like I barely scraped the surface. I did so much research for this video, and it's like I kind of explained it in layman's terms. But with that out of the way, let's actually talk about what ESG actually means and like why it's important. So the thing about ESG is that the pressure on companies, people putting the pressure on the companies to actually adhere to, you know, good ESG standards are the regulators and the investors. Now the regulators are people that are, you know, kind of put pressure on by the governments, you know, by the laws. So they'll read up like, you know, Boris Johnson said this, you need to have X number of black people, X number of women. They kind of make these quotas and stuff. They have these like CO2 carbon emissions. They have these production value standards. Obviously the EU have their own like general rules. I think they have to be approved to be sold and operated within the EU. One big example of that is like the pharmaceuticals. I know a lot of these like YouTubers have their like perfume and makeup brands and stuff in America, but in the EU, you know, in Europe, it's kind of like, nah, these aren't regulated as well as we'd like them to be, so you can't actually sell that stuff here. I mean, I know some of them actually do sell here, but they have like ridiculously high import taxes and stuff like that. But fundamentally, the rules are very, very different, and that's where the regulators come into it. These regulators will come in, you know, they'll go into the Amazons or whatever, and they'll say, look, yo, Bezos, like, you have to start meeting these standards, otherwise we're going to take away your tax grants, we're going to take away your, you know, there's a lot of government incentives. I'm not going to go into it in depth because there are just so many when I try to look into it. The most major source obviously is money, as of these tax breaks. They come in the shape of like tax rebates, stuff like that. But there are so many incentives from the governments, and as I said, the biggest one is like trade and tax, but also like just outright banning them from doing stuff. Like I know recently Facebook and Instagram, and not WhatsApp, but Facebook, Instagram in particular, have had a lot of EU pressure where their messaging services, like you can't send profiles anymore. I can't send like face scanned things in my stories anymore because like the EU are like, we're not having that, Zuckerberg. You got to adhere to these rules or you're out. And obviously when regulators come in and start putting pressure on these companies, that's when they've got to start putting more of a focus into adhering to those rules. They've got to start complying to those rules, otherwise that will affect their bottom line. Investment bodies are the other, source of pressure. They have a major source of pressure, as I say, and they come in the shape of effectively, not literally, but effectively just infinite money. Like it might as well be infinite. It's actually probably more like millions or billions, even trillions in some cases. But fundamentally, it's like it's infinite, right? And they come in the shape of like retirement plans, pension schemes, just general like everyday retail investors like me. All the money that we kind of put into like Hargreaves Lansdown or Vanguard or iShares or different companies, they can look at all of these funds, all of these companies and be like, look, we're going to invest in you if you meet these standards. And that might sound like, okay, like what does that really mean? But when you think about it, as I just said, like infinite money, well, close to infinite money, it's like they have a lot of pull, they have a lot of clout when they come up to you. When Boris Johnson goes to Jeff Bezos, like, got to do this or we're going to kick you out, he shrugged his shoulders. So look, you have Amazon Prime, you're not going to kick me out of Europe. But when UBS or Vanguard, when these men go to these companies and say, look, you got to step up, or this $1 billion fund we have here that's tracking like billions of dollars, we're going to pull that out of you. We're going to pull that out. Like that's when people start listening. That's when once money starts talking, that's when these corporates are listening. So these, as I said, like pension plans, people kind of don't always realize that they are contributing to this culture. But even if you just have a bank account, or if you have a pension, then you're typically involved in this anyway. If you're a young person and you have a bank account, don't think that you get interest just because the money's sitting there. Barclays, Halifax, Santander, they're not just seeing you have like £10 in your student account, so like here's 3% interest. Like that's not how it works. The more money they have in their like reserves, all just gets invested, all goes to the asset managers. They say, look, you interns, figure out how we're going to make this money grow, and then they'll pay back the consumers, they'll pay back the customers a small amount of that. So even if you think you're free of this, like you're not. Everyone is contributing, and as I said, money talks, and it talks very, very loudly. I can hear it right now on my left ear. The only thing is, these investors, these asset managers, yes, technically speaking, all they've got to do is like appease their bosses by making money. But fundamentally, these funds, they all work for us. It's our money at the end of the day. We're the end investor. If we put our pension plan in like MSCI, then they're going to do what they want to do with it. If we put our savings account with NSNI, they're going to do what they want to do with it. If we have a Santander bank account, they're going to do what they want to do with it. But we have the full choice to go to a different fund, a different bank, to invest on our own if you want to. You can get our app like Free Trade or Trading 212, Robinhood in America, very, very big. Like you can just do it on your own as you put your money where your mouth is. There's no need to follow the active managers. But we all contribute, and they're working for us. It's our money. So it's within their best interest to not only protect our money and grow our pockets, but also to, act responsibly and use their influence and their power to work within the means to benefit the people that they're serving in many ways. And focusing more on ESG, like it not only satisfies their like minimum means of like, ESG scores, carbon emissions, whatever, but it also just means that our money's protected in many ways. Like it means you're investing in funds and companies that are very much more likely to avoid these like big fines, fraud, all these different government pressures that have been put on them in an era now of like mounting government and social pressure, especially when it comes to, as I said, ESG, but more specifically the S part of that, and more heavily, I think, the G part of that. Because if you're looking at these pay packages and these billionaires, like everyone's talking about how they hate billionaires. Oh, Bezos, he shouldn't exist. He shouldn't be allowed to have that much money. I don't have that point of view. I've got a different understanding and interpretation of what money means and what value actually, what net worth means. But people are angry, people are angry. And it's only a matter of time before the governments react to that, before we vote in someone that is going to react to that, and before, Joe Biden starts taxing these companies even more money. And now if you're an investor, you're like, I don't really want to invest in this very high emitting company that only employs white men, because I'd rather put my money into this company, and suddenly they're going to start getting more fines and more fraud and more issues. That's just my point of view, by the way. I'm not speaking facts. As I said, this is all for entertainment purposes only, but it's very, very important, I think, to continue to maintain that focus, and it's only a matter of time, I think, before these financial institutions react to that and start acting in a way that benefits the people more consistently and more actively. I think that lends us nicely onto the next question, kind of the big question that I get asked a lot about ESG, that I've seen a lot online as well. And it's like, will investing ethically or morally affect your returns? Will that lower your bottom line? The short answer is no, and to be fair, the long answer is also no, but I don't want to say that because I'm not a financial advisor. But fundamentally, like, every company, every investment fund, every financial institution, they will have their own rules and regulations anyway. They will have their own screening policies. They have their own processes. They break down what companies they like, what they don't like. Is it a AAA investment? Is it a buy, a hold, a sell? They all have their own means of testing companies anyway. So ESG, yes, it's going to reduce the number of companies you can invest in, but we're already doing that. It's not like BP and Shell are going to be completely boycotted with ESG now like they weren't before. There are several oil and gas companies that are kind of being shunned anyway. We're looking at them like, I don't really want to include that in my index fund tracker, my ETF. A lot of these funds are only doing that anyway. Like, ESG funds already exist. It's not a new thing. So it's not actually going to affect your bottom line as much as people think. I do have a lot of data. I'm not going to show it all up on screen. If you want to fact check me, check the links in the description. But I'm going to put I'm going to put a table on the screen in front of you now. So you can see that in 2020, it's actually a very, very strong correlation between how much money companies made. A and B here, it says, are the companies that have a very high ESG score, and then D and F are companies that have a very low ESG score. And you can see it's like 16.9% more returns had you invested in ESG focused funds in 2020 than if you didn't. So that speaks volumes. There's a lot of data. A lot of it is, as down below in the description, down below beneath the like and subscribe buttons, I should say. But there's a lot of data and evidence to suggest the opposite. Like, it actually won't negatively impact your returns. If anything, it's positive. And that's just short term. As I said, ESG kind of reflects more long term sustainability, not just short term. So if they're already winning in the short term, who knows how much more money these companies are going to make you in the long term if you focus more on picking ESG focused and sustainability friendly companies. Like, traditional financial reports are always a good measure. They're always good indicators to see how healthy a company is. But adding more layers to that, adding another screening process to make sure these companies are doubly so sustainable, doubly so good investments, that can never be a bad thing. That, like, you're just making the elite more elite. And as I said earlier in the video, like, the companies that don't make that bracket, suddenly if you say we're pulling you out of this fund, you're losing access to millions of pounds now, they're going to pull their socks up and start investing more money into being more environmentally friendly. They're going to start employing more black minority ethnic people, more women that are, of course, deserving of those roles, not just to meet a quota. They're going to start divvying up the pay better and accepting lower bonuses on the benefit of the lower grade employees, just so they can get access to that fund. And yes, you can say it's not the right thing to do. It's like a means to an end. They don't really care about what they're doing. It's just to get access to that money. But, like, in the short term, it's not that big a deal. Like, we kind of just need people to be doing better. And as the bar increases, companies are going to realize that doing the right thing pays dividends anyway. And over time, you can expect a systemic change. Obviously not overnight, but it's all about long term here. This whole video is about long term. So that's, yeah. In a socially woke era like today, socially woke, I think people are going to continue to support these companies anyway. The companies that are doing the right thing, I think they're going to get the results. So that's just my take. But yeah, I think adding an ESG screen, as I said, doesn't actually affect your bottom line. But one thing that people need to think about is like the difference between, as I said earlier, way back in the beginning of the video, it's like the lines between ethical investing and ESG. And there's this other field formerly known as SRI, which is socially responsible investing. I myself, I've personally invested in MSCI. I always get this wrong, but it's MSCI UK Socially Responsible Fund, it's called. Or it's like an ETF that, I've got it somewhere here actually. MSCI, yeah, it's an ETF that tracks an index of positively ESG focused UK firms. So it's basically everything that I've been saying. It's all the companies that MSCI think is, appeases their minimum standards for ESG, and they're kind of putting more money into those companies. I think it's ranked as like 6 out of 7 for high risk, high reward. So obviously it's considered risky, So that's my one contribution. But yeah, I think I believe in it. I personally invested a lot of money into that. That takes up a big part of my portfolio, and also like global green energy, digitization, and a lot of different ESG heavy funds. So I'm not talking smack right now. Like, it's something I actually believe in myself as well. I think SRI is a great compromise here because they balance in many ways, financial returns and also, ethics in many ways, doing the right thing. And the way they do that is by ESG says, like, if you're doing the right thing, we'll give you money. If you're not, forget about you. SRI investing is kind of like not the opposite, but it's a bit more comprehensive, where it's like, if you're doing the right thing, if you're investing in social housing or like clean water projects, things like that, we're going to champion you guys and give you guys more money. But if you're not doing that, we're not going to penalize you for it. You're still going to get part of the, you're still going to be part of the fund. You're just not going to get as much money as the other ones that are doing more. So that way it enables you to kind of diversify, and it also allows you to have a kind of a bottom line. So if the companies do start doing well that aren't doing the right thing, according to my rules of ethics, they're not doing the right thing, but you're still investing in them anyways in case they do start making a profit, and you're obviously going to benefit from that as well as the fact that you're championing the companies that are doing the right thing and that are more ESG inclined. The issue with like ethics, as I said before, is like everyone has their own interpretation of what ethics means. Some people won't invest in companies that sell alcohol. They will avoid pharmaceutical companies that do any animal testing or things like that. Where SRI kind of offers the perfect compromise, because as I said, people that are like-minded, that fit into certain groups, can pick a fund that is socially responsible based on their standards and then invest in that, as opposed to taking these generic, kind of more broad ESG scales. Like an alcohol company, for example, could easily employ a nice range of diverse people and pay them all well and not affect the environment very much, and they can have a very good ESG score but not be what you deem ethical, not be an ethical investment. That's where SRI kind of comes into it. And obviously if you do fit into a specific religious group, as I said before, there are a lot of like Islam funds, there are a lot of Sikh focused funds, and these funds do exist. I know some groups of people don't believe in investing at all, because they see investing as like glorified gambling, which I'm not, I can't really disagree with. But if you are going to invest, obviously this isn't the video for you. I'm not going to preach about every individual person here, but ESG and SRI and all these different funds kind of open the door almost to a sustainability conversation. We're talking more about long-term repeatability, reliability, sustainability, all these buzzwords I can just keep throwing all day, but we're talking more about a bigger picture here, as opposed to individual, an individual needs, an individual's means and what they want as an individual person. So yeah, like if you are an individual that are super concerned about certain aspects about certain companies, obviously do your own research again. I mean, everyone should do their own research, but I would say if you care a lot about companies, what they do, it's not always ideal to invest in a fund. It's probably better to just invest in individual companies, or of course look at specific funds that meet your needs. But otherwise, like ESG and SRI, as I said, ESG and SRI, environmental, social governance, and socially responsible investing. You see, there's too many words going on in my head right now. But these two sectors, these two niches within investment culture, as I said, they open a door for a much bigger conversation. And hopefully, the more people that understand it, the more people that invest in it, the more people that, even if you don't believe in it entirely, you kind of show some sort of interest in it, it's going to eventually affect the mainstream and how these companies think about what they're doing, how these investment funds think about who to pick and how they're going to get the most money reasonably and effectively divvied up between the companies they believe in. And yeah, I think it's a good thing. I don't see any issues with ESG investing, with socially responsible investing. And me myself personally, I already do have quite a big holding in ESG focused funds. I'm trying to put more money into things I believe in morally and ethically and financially is the big thing, of course. I'm not like a super social justice warrior or anything like that. I still do want to make as much money as I can. But yeah, I do think that there is a strong correlation, as shown by the graphs, as you will probably find out as well in your research below. There's a lot of evidence to suggest that you're not actually compromising value here at all. So yeah, that's it for me. I'm definitely going to be taking a lot more, a lot more of a deeper approach to investing now. Not just in terms of ESG, SRI, but also like what I might actually put my money into. And yeah, ultimately, I think people that are doing the right thing will eventually result in, well, results, I guess. You're gonna get the results. The nice guy always wins. I think in 2021, the greener companies are going to win. The responsible companies are going to win. The people that care more about society are going to start winning more. You know, I'm buying Ben and Jerry's now. Like, these guys are winning. So that's it for me. I've kind of gone on for a bit of a while. Apologies for the long video. I'm trying to make my video shorter this year, but ESG is something that I thought I had to get right. I had to put in everything that I found. And even what I just said only scrapes the barrel. There's still like so much more out there that goes into it. It's quite complex because, as I said before, every company has their own approach to ESG. They have their own data points. They have their own weighting scales. But fundamentally, they all have, you know, ESG means ESG. It means environment, social governance. And I think it's going to be a mainstay in the future for many years to come. But again, for the final time, I'm not a financial advisor. Do your own research before you invest in anything, please. And yeah, I hope you guys have enjoyed it. If you want to see more videos like this, let me know down below in the comments. I'm going to try and be the UK's, you know, financially savvy student guy in 2020. So look forward to more content like this, more thought out projects as well, as opposed to just me talking smack for half an hour. But that's been it. Hope you have enjoyed, and I'll talk to you guys in the next one. Peace.